Are you curious about how real estate investors manage to fund their projects so seamlessly? It's not just because they have deep pockets. Many are tapping into a resource known as hard money loans. So funny enough, getting a traditional loan for real estate can be quite a hassle and time consuming. When time is a crucial factor, these investors turn to hard money loans for a fast and effective financing solution. And here's a little known secret. You don't always need a perfect credit score or a steady income to secure these loans. In this video, we're going to explore the world of hard money loans. We'll uncover what they are, how they work, how you can use them to boost your next real estate investment, and how much they typically cost. I'm excited to share the inside world of hard money lending with you, as I've been a hard money lender for several years now, having originated over $100 million in loans to investors across the country, many of whom I've met at real estate meetups, on the internet, and even through friends. In this video, you'll learn some valuable tips from getting the best rate to ensuring your deal goes through smoothly. I'm going to cover it all. We'll discuss why hard money loans are a go-to for many, the process of securing one, and the essential questions your lender will ask when figuring out if they can even give you that loan. So let's dive in together and learn how you can leverage hard money loans to your advantage in the world of real estate. So to start, let's break it down in a way that's easy to understand. Think of hard money loans as your fast pass to the real estate world. While conventional banks need your income details, your tax returns for 2 years or more, and a hefty 20% down payment for a property in pristine condition, hard money lenders operate differently. They recognize that many properties with investment potential often require work, or significant work. House flippers like the ones you see on HGTV aren't eyeing beautiful properties ready to move in. They're looking for the fixer-uppers. They're looking for the properties with tall grass. They're looking for the properties that have a hoarder living in it, so that they can add value by redoing the property and making it look like a property that some new buyer would want to move into. This is where the profit lies for fix and flippers, and this is where the profit lies for me as a hard money lender when looking for a prospective borrower. Where conventional banks are looking for a stable borrower, someone who has a 9-to-5 job or can show consistent income in the business that they own, hard money lenders are clued in about the life of real estate investors. Their focus shifts from the borrower's personal financial situation to the potential profitability of the deal itself. Now, you may be thinking to yourself, what is the big advantage to hard money loans? Well, number one is speed. Hard money lenders can close quickly because they often skip the full property appraisal. Instead, they use something like a BPO, which is a broker price opinion. This allows them to quickly estimate the current after repair value, or ARV. And once more, they're not hung up on your debt to income ratio, which essentially qualifies a borrower by their monthly income by taking a percentage of their monthly gross income and deciding, okay, well, within this amount, can they afford the payment? This flexibility means that you could have several outstanding loans. And as long as your new deal is promising, you're all set. This flexibility for fix and flippers is huge, guys, because a lot of flippers don't focus on just one deal at a time. In fact, I've met fix and flippers that have 10 and even sometimes 20 projects going at one single time. Hard money lenders tend to have higher interest rates. For example, a standard 30-year bank loan might charge you around 6 to 7% interest in today's market. It's 2024, it's January. But with a hard money loan, you might expect to see something in the ballpark of 10, 11, 12, and sometimes even 13% interest. Now remember, these are interest-only loans, so your monthly payment might not be significantly higher than a conventional loan. What you do need to look out for is processing fees. They typically range from $500 to $2,500. On top of that, you're going to see origination fees. These range between 1 and 3% of the entire loan amount. Now, that origination fee is going to be your largest expense right out of the gate. So you kind of want to know what dictates whether it's 1%, 2%, or 3%. And the answer is super simple. Typically, it's how unique is the deal? How hard is it for the lender to get it funded, and how much work is it? Also, what's the loan amount? So for a $500,000 loan, you might pay 1%, which is $5,000, or You might pay 2%, which is $10,000 in origination fees. Now, expect to pay an additional 1 to 2% if you are planning on using a broker. For example, I'm a direct lender. If you come directly to me, you will not pay broker's fees. If you go to a broker, you might find that they have many more options for you, although you're going to pay significantly more. One key aspect of a hard money loan is their shorter lifespan, usually a year compared to the 30 years of a standard loan. This means if you're taking a hard money loan, you need to have a solid plan to buy, fix, and then sell that property within the time frame. Or you need to convert it into a long-term loan to avoid any risks if you don't want to sell and you want to turn it into a rental property. So again, hard money lenders don't fuss over your income details or your tax returns like traditional banks. They're more interested in the specifics of your investment. When you reach out to them, they'll likely have a pre-screening questionnaire. This will help them get down to the bottom of whether they can help you or if you need to go to someone else. For example, I have a list of nearly 13 questions that I ask every single investor to figure out whether their investment will fit my loan products. They'll ask for basic personal details and info about your investment type, whether you're buying in your own name or in an LLC, a corporation, or a partnership if you have partners. If it's through an LLC or a corporation, they'll want to see your paperwork like articles of incorporation, the operating agreements to verify everyone is involved in the loan. Guys, there's so much more like purchase price. They want to see the purchase contract. They may want to get your estimate on how much money you need to fix up the property, as well as what you think the property will be worth after you fix it up. Again, we talked about this. This was ARV, after repair value. Now, once you make it past this pre-screening and a lender takes your loan on, there is what's called a due diligence phase, which includes checking where your funding is coming from. And by funding, I mean your down payment. Where is the money coming from that you're using to put that down payment on the property? What's funny, guys, is every lender has different rules when it comes to sourcing your down payment. Some allow you to source it from an investor. Some allow you to source it from a family member. Some allow you to source it 100% from a partner. Some force you to have at least 20% coming from every single partner in the deal. And when I say 20%, I mean 20% of the, say, 10 to 20% down payment, because the lender would be coming in with, say, 80 or 90% of the purchase price value. That lender will want to see bank statements and they'll want to understand your credit score. Larger lending companies handling billions in loans often offer the best rates, guys, but they will scrutinize your credit and any mark on your credit. A higher credit score means lower rates, but a lower credit score could still get you a loan at higher interest rates. Some lenders might not check your credit at all, but expect higher interest rates and often origination fees if that's the case. They'll also probe into your real estate experience, focusing on the number of deals that you've completed in your name, sometimes in the past 2 or even 3 years. So someone has a much better chance of getting a hard money loan if they've completed, say, 5 fix and flips in the last 3 years, as opposed to the guy who has never done a flip. This doesn't mean that the guy who has never done a flip doesn't get the loan. It just means he will likely have to pay a higher interest rate. So the more deals you've completed, the more favorable the rates you might receive. Additionally, they'll access your liquid reserves, including your cash, your stocks, and possibly your retirement accounts. This assessment ensures you have enough funds to cover the down payment, the closing costs, the renovation budget, and 6 months to 4 months of holding costs. It's a safeguard to prevent financial strain once the project is underway, because the last thing these lenders want is a project that is stuck at 50%. Now let's talk about the property. Hard money lenders will want all the details, the address, the type of property, whether it's a single family, a duplex, a triplex, or a quad, whether it's a vacant or tenant occupied property. Different property types will affect how much they're willing to lend, with single family homes often being the easiest and the most favorable. They'll need to know the agreed upon purchase price and any additional fees such as wholesaler fees. It's recommended that you have a contract, a purchase sale agreement in hand before filling out the pre-screening form to avoid any wasted time. The last thing you want to do is waste your lender's time. They won't take you seriously, and they'll put you by the wayside while other investors bring qualified deals to the front of the line. In regards to wholesale fees and assignment fees, different lenders have different policies, so it's important to clarify this upfront if you're using a wholesaler to find the deal. A lot of lenders will not allow you to borrow on an assignment fee. If, for example, a property is being sold for $500,000 and there's a $20,000 assignment fee, well, the lender is not going to give you 80% of that assignment fee. They'll also inquire about your budget for renovations and the expected duration for the work being done. This information helps assess the risk levels of the loan. The anticipated after repair value is super crucial, guys, as it helps both you and the lender gauge the profitability of the deal. If you're tackling a major project, they'll want to know if plans and permits have been approved by the city, as this can extend the project's timeline. Your desired LTV ratio and whether you need a rehab loan are also key questions. New investors might be limited to 80% of purchase price, while experienced investors might access up to 90 and 100%, covering both the purchase price and the renovation costs in total. The closing date is another crucial piece of information, setting the timeline for lenders to complete necessary inspections and evaluations. Guys, by providing thorough and accurate information, you position yourself as a professional, reliable investor, making lenders more inclined to work with you, as I've said before. After all of this is given, they'll crunch the numbers to ensure the loan amount is a sensible percentage of the ARV, aiming for a loan amount that is less than 70% of the ARV to ensure room for profit, right? Because what happens if there is no profit and someone gives you a 100% loan? You have no skin in the game and you have no push to finish the project, leaving the lender with something that they have to do themselves for no profit. Remember, hard money lenders aren't keen on funding deals that might lead to a loss. So to put that in better words, hard money lenders are not in the business of funding deals that lead to losses or foreclosures. Foreclosures can be costly, they can be time consuming, and they're just a process that no one wants to go through. To secure the best rates, aim for a high credit score. You want to build that credit score up as much as possible, guys. There's other videos on my channel that will later go on how to build that credit score up as quickly and efficiently as possible with some extra little hacks. Again, lenders often offer more favorable rates to those with higher credit scores and with at least 3 projects in the last 2 to 3 years, with the best rates going to those with over 20 projects under their belt. The more capital you have, the more comfortable lenders will be. So if you have $1 million in your bank account, they're much more comfortable with your deals as opposed to having 10 grand just trying to rub 2 sticks together and make a fire, guys. Requesting a lower loan amount or a lower LTV than the maximum or what you do qualify also helps in securing lower rates, as it's seen as a safer loan for the lender. Personality matters too. Being respectful, being easy to work with can lead to discounts on processing and origination fees. On the flip side, difficult and demanding behavior, which I've seen all too well, might not win you any favors. Now, if you're in the market for a hard money loan, consider Keeler Capital. We are both a private and hard money lender that has done over $1 billion in loans. We do fix and flip loans up to 90% of the purchase price and 100% of your rehab costs. We do commercial loans, we do multifamily loans, we do construction loans, we do long-term rental loans, and we do portfolio loans, guys. We do everything under the sun. So give me a holler if this is something you're interested in. We are a one-stop shop when it comes to hard money and bridge loans. Now, on the flip side, if you're not looking to take a loan, you may want to look into becoming a hard money lender. And if you want to take the first step in learning how to earn huge commissions by lending hard money, click the link in the description to explore my program and community, Lenders Academy. Now, Lenders Academy is a comprehensive course on real estate lending, focusing on building a successful lending business. The key topics covered include the fundamentals of lending, understanding the basics of real estate lending, including different types of lending like first trust deed lending, mortgage lending, hard money lending, and private money lending. The course teaches you the math behind lending, the calculations, the financial aspects essential to real estate lending, including all those fun ratios and interest rate examples for profitability analysis. The program then teaches you how to start your own brokerage brokerage and provides guidance on setting up your own real estate lending brokerage, including business plans, regulatory compliance, operational setup. Our course then teaches you how to market and find borrowers. We teach you how to pre-qualify loans, we teach you how to sell loans to the client, and we teach you how to process and collect documents for that loan for submittal. But the best part about Lenders Academy is that we provide you with the same capital partners and investors that fund our deals, so that you walk into every situation with billions of dollars backing you, so that your only focus is stacking as many deals in a month as you possibly can. So click on that link in the description if you want to watch the full video and description of our program and community, Lenders Academy. I hope to see you there, guys. Now, I hope this general but deep dive into hard money loans has been informative and helpful. And if you have any questions, feel free to drop them in the comments. And now that you're equipped with the knowledge of securing a hard money loan, the next step is understanding how to assess if a deal is worthwhile. For that, I will create another video assessing a fix and flip deal. I get them every single day like clockwork, sometimes 5, 10 scenarios in a single day. So wait up for that video by subscribing and you'll get a notification when it comes out. Thanks, guys, and I look forward to seeing you in the next one. Take care.